Surprise, surprise, a Twitter thread involving a popular streamer caused some attention the other day, but this time it wasn't because of political opinions, a crypto coin, or a fake booty. This story involves the purchase of a gas station. Yes, a gas station. Twitch streamer Amouranth reveals high tax bill buys gas station. I've never heard anyone say her name, so I hope I'm pronouncing it correctly. On a Twitter thread, she claimed that her reason for buying the gas station was that she would make money by buying it through a savings in taxes. Since I love uncovering the financial side of influencer culture, I figured this would make for an interesting deep dive. Okay, here's why I bought a gas station. A Circle K no less. It cost me $4 million or minus $110,000 depending on how you look at it. Yeah, that's a negative sign. I was paid $110,000 and got a gas station free, and I or you can do it again and again and again. Twitter was set ablaze with the minus $110,000. How can someone invest in a business or real estate and get paid to do it? Or is this not accurate at all? To get to the bottom of this Twitter conversation, I decided to ask a friend to join me today. He is someone who I respect on YouTube and think many of you will recognize. We begin with the main issue at play with these tweets.
She says that she is going to get a $1,110,000 tax deduction by making this investment and having a $3 million depreciation.
Some of you may recognize JT from Pocket Watching with JT. I wanted to bring on an expert to not only discuss the specific example of influencer math, but also help educate everyone on depreciation in real estate. Now, since we bought this gas station and in accordance with applicable laws and once structured correctly, I will take an accelerated depreciation charge of approximately $3 million. Here's math of her calculating the $3 million by her marginal tax rate of 37% to arrive at the $1.11 million number. So for 2021, I will owe $1.11 million less in income tax.
But if we're talking about a 37% marginal tax rate, that's her personal tax rate. That's not a business tax rate, because if it was a corporation, you would be limited at the 21% tax rate. So if we're talking about her personal tax rate, that means this is a passive investment for her. And if it's a passive investment, you're limited to only taking a deduction from a passive investment against other passive income. So she probably wouldn't be able to deduct any of this passive loss against her ordinary income.
Amouranth is a popular streamer who makes her income from her presence on multiple social media platforms. Anyone want to take a guess on how much money she makes? Here's her responding to a tweet. Bruh, I'm gonna pay like $6 million this year in federal income tax. Holy smokes, $6 million in tax alone? At a 37% tax rate, she's earning roughly $16 million this year. That's $1.33 million a month.
Salute.
Thank you. Yeah, I'm really excited about it. Last month was actually my highest month ever.
Whoa! You're going to tell me how much you made?
Yeah.
Oh my God.
1.1 million last month.
As she revealed to Investment Talk, Amouranth's OnlyFans still brings in over $1 million every month, but the other platforms have got some pretty impressive figures too. She gets $189,000 per month from Patreon, another $17,000 from Fansly, and between $10,000 and $25,000 a month from Instagram. The streaming star also makes an additional $133,000 or so a month, split between Twitch, TikTok, and YouTube, as well as between $5,000 and $15,000 from Twitter. This is a very high income earner looking to invest in other industries to make passive income and offset taxable income if possible. The problem is that she isn't a real estate professional, which matters in the tax code. First, we'll start with a simple explanation of depreciation.
Depreciation is taking the total cost of an asset that a business purchased and slowly recouping it by taking a little bit of a deduction each year over the lifetime of that asset.
When you own rental property, you are allowed to depreciate the building over a set number of years, which offsets your income earned. If your depreciation expense is $10,000 each year and you earn $10,000 in net cash flow, then you actually pay $0 in taxes because they offset. And it's completely legal. There's a reason why wealthy business owners start funneling a lot of their money into rental property.
She's basically an entertainer. That means all the income that she makes from her streaming is going to be subject to self-employment tax, which is 15.3%, because this is active income.
Since Amouranth posted in her tweet that she was in the 37% marginal tax rate bracket, we both assume that she's indicating that her main source of income is active personal income.
This is not an active business venture for her based on what I read in her post. This is not something that she's going to be managing. She is not considered a real estate professional. And because she's not considered a real estate professional, she is still limited to the same passive losses that a Ma and Pa small landlord would be limited to, which would be you can only deduct those passive losses against passive gains. And the bulk of this girl's income comes from ordinary income from being an online influencer.
I ran into this same issue a few years back when I lost money flipping houses. I made a certain amount of money with my personal income and lost a certain amount of money flipping houses. I found out the hard way that I wasn't able to reduce my personal income by the real estate losses.
The main issue is I don't think she understands the difference between a passive real estate investment and an active real estate professional's business. She is not a real estate professional who's running a business. If she was, she could take those losses against any other form of income. This is a passive form of investment in real estate. So she's limited to only deducting passive losses against active gains.
We can only go off the information she posted in her tweets. What JT and I believe to be true is that she is attempting to offset personal income with business losses, and these two are not combined. The way she could make this work is if she has $1.11 million in net income from real estate activities, and she uses the $1.11 million in passive losses from depreciation to offset the income. This would be a common way for a real estate investor to earn $1.11 million in net income, but pay $0 in taxes. To our knowledge, the income she claims is her online entertainer income and not real estate income. Based on the information provided, she would not be able to offset her personal income with the passive losses from the depreciation of real estate. Remember, I invested $1 million to buy this gas station. Now I owe $1.11 million less in taxes for the calendar year, so we get back or save $110,000. If the tax strategy was applied correctly, then this would be a great financial decision. Instead of sending $1 million to the government, put that money towards real estate, take the huge depreciation in year one, and save $110,000 more than what you paid. In the meantime, we're putting money to work that we wouldn't even have anymore otherwise, tax liability. And we acquire a gas station generating $85,000 a year in rental income. Forget the misinformation about taxes for a second. If she's making $85,000 a year net passively from a large company leasing her property, then that's a great investment. People like her who earn $1 million per month don't need to get rich twice. Once you reach that income level, the goal is preservation of capital and reducing the tax burden while growing your wealth. And one way to do that is something we discuss next. We will not own this gas station forever, though we could. We will likely sell and roll capital gains forward.
What she's referring to is a 1031 like-kind exchange. Now, in its most basic form, what you're doing is you are taking one piece of real estate that you currently own and you're swapping it out for another piece of real estate that is either equal or greater than in value.
If you want to see someone doing this on YouTube, check out Ben Mal's channel where he performs 1031 transactions all the time by buying hotels, renovating them, selling them, and purchasing another property within the 1031 window.
So when you roll one property, the first one that you bought, and then you sell it and you do a like-kind exchange, what ends up happening is you virtually take your basis, the amount of money that you originally invested, and it goes into the new property plus any additional cost. So you just continue to keep track of what did you initially invest in this property? And then you look at what are you finally going to sell, whatever ending property that you end up with, what do you sell that for? The difference is going to be your capital gain. But here's one thing that people do not consider. All that depreciation that you took from the first property to the second property, it doesn't matter if you flip the properties 100 times. All the depreciation that you took over the years now has to be recaptured, meaning it has to be added back into this sale. And that all of that recaptured depreciation is going to be taxed at 25%. Then you're going to pay capital gains on whatever is left in that sale.
Amouranth appears to have posted a response to the messages she was receiving. A CPA messaged her about her posts and states numerous instances of her plan not abiding by the tax code. Her response, Cold day in hell when an e-girl destroys a CPA with a master's degree in his chosen field. Her message response at the bottom is about the oil and gas industry offering a 100% bonus depreciation. She even says, "Wow, you're a bad CPA." I think she's still confused as to why this guy believes she's in the wrong here. The main issue she will be facing is attempting to offset personal income with passive real estate losses, which isn't applicable for this 100% bonus depreciation. Another confusing element of her post is that the $3 million depreciation matches exactly with the size of the loan.
There's no way that the loan of $3 million and what she is proposing, her $3 million worth of depreciation, are related. That's just not how these things work. The depreciation is going to be based on the actual value and the investment in the real estate.
It's entirely possible that the building, or whatever will be depreciated, came out to exactly $3 million, and it was just a perfect coincidence, but I would hope she isn't conflating the two. Her remarks towards the CPA seem a little arrogant for someone who isn't a CPA. Maybe there's a lot of misinformation and unnecessary confusion in this situation, but it does seem like her strategy doesn't align within the tax code. This video isn't meant to expose anyone. I thought it would be an interesting breakdown of an investment in the tax code in hopes that we can all get to a point where we're needing to buy gas stations to offset the expected $6 million tax bill. To those of you who sent me this, thank you. Make sure to check out JT's channel as he exposes a lot of fake gurus too. I hope you enjoyed the video. Thanks for watching.